Hey everybody, welcome back. I just want to start this off. See this little button down here? When you click it, you see the difference in the chart. If you want to know why your chart's not set up the same way, you might want to click that button. All right, so if we take a look at where the ES is on the weekly, we can see that the RSI is here, and that we have this. So we have what we would refer to as a negative divergence. Now, there could be a litany of reasons for this, and it could also reset itself, but we have this. And we're going to talk mostly about the Fed and what we expect tomorrow. But I think it's really important to just kind of understand where you are, as I refer to, in the food chain and what's going on here. So we're going to look at a couple things very simply. Again, just make sure that when you're looking at your data, you're looking at the right data. Now, if you go down to here on a daily, and we look at this on the daily, you can see that you're going to have to come back a little bit further for that to actually stay in the same spot, but you're there and it's still there. Now, this is where it gets really interesting to me before we get into, is it 25, is it 50? And let's be really clear before we even start. There's not one investment bank out there that has a clue. Okay, they are all on different sides of the table. 25 years of doing this, I'm gonna just be blunt. I've never seen anything like it. Sometimes people say, oh, you say that a lot. No, you've never seen so many disagreements on whether it's good or bad. Whether or not what they're going to do, but you've never seen more disagreement on whether or not it's good or bad. And we have a ton of disagreement out there right now. Now, if you look at this wedged in area, we watched us fall apart, and then we got right back into that wedged in area, and then we just fell apart on Tuesday around 12 o'clock. For what reason, we can only guess. Maybe it's the war, maybe it's jitters, maybe it's the bond market, right? We can come up with a litany of reasons on why this happened, and we're not going to spend a lot of time on it because we know we have light volume, but we need to know where we're at. And there's a couple different ways that I view where we're at. The number one thing that I do is I come here and I look at these clouds, and for time's sake, what I will do is I'm just going to get rid of the smaller cloud, and I also use a 20 EMA. We're going to get rid of that. And I like to look at this on an hourly. And these cloud flips, they help me greatly when they flip. And what you'll start to see is when you'll start to see the turns is when you're below them. So for me, one of the things that's starting to become troubling is when I wrestle with it. I don't like that. I don't want to be in this, right? I want it to either break or don't break because it's giving me uncertainty. And that's going to be the key word with equities right now. You have massive uncertainty when you look at some of these charts. And we're going to go through a couple of them here. But when I focus on that, it's not going to make me feel warm and fuzzy. Now, if I look at this on a 4-hour, which I tend to do sometimes, I would look at that and go, okay, I feel a little bit better, but we're really still not going anywhere. So then I overlay this with something like RSI on a 4-hour, and I see that we cracked and we're starting to roll. Now, that doesn't mean you can't go higher. And remember, each one of these is 4 hours, right? So you have to take that into account. But is that a place where I'm feeling warm and fuzzy and want to start putting a bunch of trades on? Or do I want to do it when the RSI is completely busted for 4 hours and look at putting longer trades on there, right? I mean, you can pretty much see how this goes when you're at the top of this RSI, whether or not you believe in RSI or you don't. If you don't, I would suggest that you look at it. Timed something perfectly for us today when the market sold off. So once you understand how to look at these divergences and understand how they work, it gets really very clear on what you should be doing there and how that might play out. So you can see it right here, the lower low, and then you can see the what? Higher low right here, right? Those positive divergences, and that did mark the bottom of that market. And it was pretty clear when we put that in the community today. But, and again, it doesn't mean that you're going to rally back up, but it does mean like, hey, give it a pause. Same thing on a 4-hour. When we start to see stuff like this, we want to pay attention to it. So right now we're kind of in line. Maybe you could say that you're kind of in line, but flipping it still doesn't make me feel warm and fuzzy. So then if I go and look for other indicators into just the S&P futures market, like the Ichimoku cloud, and say, okay, what do I have on a 4-hour? Well, I'm still wide awake, still wide open green, and I'm still above it. So that's good. Drop that down to the hourly. And then we can see that we're starting to test it in here. Now, this is where it gets super interesting, at least to me, but maybe I need a hobby. So when you start getting into this, think of it like quicksand, like you are in here. You need to be one way or another. You can see how it rallied right to those areas and rejected. Now, what will happen here in the next hours, every bar that goes sideways that does not get above that 5710 level will be in the cloud, that bar right there. So if you think about it, by the time you came through here on Wednesday at 11 o'clock, right here, if you look at that clock, I'm going to be on the other side of that by 2. That's not great, okay? And by then, these probably have crossed. So you're going to want to watch this, and if I can give you one piece of data that you're going to want to watch tonight, you're going to want to watch that 57.23 level. You're going to want to see how that goes. Now, if we take a look again at the NQ, which we can do, right? We can see, let's clean off our levels right here, and we can see that we're already in here, been in here, tried to rally out of it, and they pulled us right back in, right? And now you're going sideways again. This is not where you want to be. Now, as always, we have to just take a step back and understand that we have something very significant to go over here, right? And this was when we start getting into the stool and understand the macro, the fundamentals, and the technical of the market. We have to say to ourselves, okay, this is great. I love your little clouds, but we have rate cuts tomorrow, 25, 50. And if this happens, then that's going to happen. And then this, and then the Fed, and then the dot plot. And then Powell's going to speak. And does he bring the iPad? Not bring the iPad, right? And then this refers to our stool. And this tells us, macro, fundamental, technical, and tells us, when we're sitting at the stool at the bar having our drink, we don't want a one-legged stool. So we have to look at all this. This is one part. This is the technical. This is going to tell us when. Macro, meaning the rate cuts, and the data, therefore, following those rate cuts, i.e. the speech and dot plot, are going to tell us, what. Then we're going to see who's affected, and which is the fundamentals, and then the when is going to tell us when to get in. So this is one side of it. The important part of this is that we must look at what the investment banks are telling us right now, because they are all over the map, and there's good reason for it. Take a look. Now, I thought a lot about this, and we're going to do some analysis here. I wanted to show you how crazy this is, what's going on. And the best way that I can do this is clearly just by showing you how the investment banks differ. So for those that are new, I get access to a lot of information, a lot of research, and I go through it all. I collate it because no Dropbox. So I'm going to give you excerpts of some of the information that I looked at in regards to the Fed that I found most interesting. So this is just from one bank right here. And what I want to point out is their thought is very, very clear on this. They give their summary, and it's rate cut in September. He has not given any hint about the size of the September cut or the pace or the size of the rate cuts thereafter. And that is very true. We're all estimating these out where we're saying 232 basis points in 12 months. Powell hasn't said anything remotely like that. Are we leading ourselves up for a little bit of disaster here? We're going to get into that a little bit and how people are looking at this at different investment banks. The one common theme that you're going to see in all this is nobody agrees. That makes tomorrow really dangerous, and that's why I want to focus on it. We expect the labor market to deteriorate further. Now, this is going to come into play later when we start talking about the next 3 months and whether or not there's a recession, or whether or not we have increased productivity. And I'm going to show you some other things in there that I think are very important. Leading to 4 consecutive rate cuts of 25 basis points each. So this investment bank is saying 25 basis points each right in a row, again. There is substantial risk to 50 basis points at one of these meetings, including September, although it's not the baseline. So this bank is on the other side of this saying, hey, I understand that the Fed tool and CME, the bet is 65% right now, as we all know. We think it's 25. Given the data so far, we expect 25 basis points. It's a close call. The lack of guidance could indicate the FOMC has not reached a decision. This very well could be the case. I personally think they're clueless. What's more, retail sales could alter the calculation. I agree with that too, because today we had retail sales that were better than expected, and that was due to the auto industry, which is very clearly linked to the consumer. So they could look at data even up to today and make a decision. It'll be interesting to hear his speech tomorrow at 2:30 and hear what he has to say about that. But if we look at this, what happens after January is a large extent dependent on the policies. Trump gets in, universal tariff. Whether what they say and what they do are two different things, but there is an issue here, and they are right. If Trump gets in, you could have a rebound in inflation because of tariffs. If Harris gets in, it would likely be less inflationary. So what they're suggesting is this. You're going to know more in the next 30 days, 60 days, and 90 days. And this is usually how it goes when you're at these rate cut spots. And this just happens to go into an election cycle as well. So that's also what makes it so interesting. But this is the baseline we're going to start with. And just to show you the significance of this is just from the Commonwealth of Australia. And obviously, everybody's waiting to see what happens tomorrow. U.S. shares higher on Fridays. Investors continue to chance larger 50 basis point cut. Bond yields fell. Former New York Fed President Dudley said there's a strong case for a 50 basis point rate cut. We expect 25. Okay, so Australia, Commonwealth, expecting 25. Cannot rule out 50. Chinese economic data over the weekend was soft. Highlight continues weakness, and they're just talking about what's going on the spread of their currency versus the dollar. Now, this is where it starts to pick up a little bit. This is from JP Morgan, and they had a macro conference, and I just want to go through this. Little focus on recession risk. Corporate and household balance sheets remain in good shape and reflect mid-cycle rather than late-cycle dynamics. So they're saying, okay, we had this conference. It's all macro, and one of the things is we don't really see recession risks. we think we're in a mid-cycle rather than the tail end of a cycle. We continue to see outperformance versus the rest of the world. Yields are still attractive, and we're preventing an exit from the US dollar carry trade. That's interesting. Okay, so these, again, top 10 takeaways. We're not going to go through all 10, just the ones that are linked for tomorrow. There was not much conviction that the Fed needs to ease aggressively. Okay, so right now, and again, this comes out today, we are pricing in 50. That is what's being priced in the equity markets. They are saying 25. Okay, if they're coming out and saying Fed needs to ease aggressively, and you're saying there's not much conviction that they need to do that, well, maybe they feel that way too. Relatively painless disinflation with inflation expectations surprisingly well anchored with evidence of policy and institutional inertia. Okay, maybe institutional inertia, think La Congress. Maybe too early to declare victory on inflation, also premature to call the end of gradualism, although more inertia observed during policy hiking cycles compared to easing. No focus on fiscal discipline. This is true. No one's paying attention to the deficit and what's going on there, the U.S. debt, and that's what's going to make yields attractive. So this is an issue as well. Fed risk creating more extreme housing affordability. Once they start cutting, and the way that they start cutting, if they start cutting too fast, people are just going to start flying in the house. And this is going to create a whole litany of issues. I personally think it's good for office space, but it is going to create a whole litany of issues. But so far, we're seeing a lot of people really not sure two things. One, we're not seeing how much we're going to cut. We're not having any real consensus. The other thing that we're seeing is we're not even sure what it's going to do to the market. Does the market go down on this? Does the market go up on this? So far, 3 different banks, none of them are in agreement. And I think that's really what you have to take away from this. We have never had a situation like this before where you have had so many banks saying so many different things and us not having guidance, yet we're all supposed to believe that miraculously we're just going to cut 232 basis points on the way out. Now, are we? Maybe we are. But in 12 months, I don't know. And the way that we're pricing it in right now seems pretty aggressive. So, food for thought. Why would 25 be worse for equities than 50? And like JP Morgan is posing this question. These are the inbound questions they were getting. Why would it be worse? If that happens, what does it mean for the market? There have been many comments made around 50 basis points as a bad signal for the economy. I'm inclined to challenge the narrative. So what they're suggesting is that bad for the economy if they do 50? Although it's impossible to conclude what Powell will do, we certainly can conclude one thing. The variety of articles on Thursday through Monday appear anything but coincidental. I agree with this. This is what we refer to as leaking. So they're floating that out there to see how the market is going to digest this. Now, this does two things. This means that if they do 50, we're expecting it, and therefore it's possible that interest rate bearing activities or asset classes rather like REITs, utilities, bonds, they might sell down on it because now the expectations are built in. Sunday we went from 50-50 to 65 to 50 basis points to 35. Nothing really changed except that, quote, this started happening. And I think there's something to that. And I think she has a good point. Now, I know some of this might read like stereo instructions, but the important part of this is to get an understanding of how confusing this actually is. Scales have tipped more jumbo 50 basis points to kick off the easing cycle. Context is fairly important. CPI ahead of the stream articles more decisive 25 ease. What journalism has done is still doubt the 25 basis point narrative and reopen the door towards that 50 basis point, which they did. It's essentially brought back market towards Waller's open-minded rhetoric, closed off the 25 cut, reducing the 50 basis point shock. So what they do, they call it floating a balloon. They float this out there and they see how people respond to it. People so far have responded favorably. When this started being floated out there, we didn't drop down, we actually went up. So if they rip the Band-Aid off, what happened? Which they might do. And if they do that, then maybe we do get an equity rise. But we still have to deal with the dot plot, which we're all aware of, that comes out quarterly. And then we have to get through itchy speech. But I do think it's interesting how they're floating this out there. It also makes you wonder if these institutions are floating this out there, which I tend to think that they are. Now, reducing the shock. I'm curious to hear what that is the market has seen as a possibility already. Risk-reward standpoint, then thinking about 50 versus 25, ease. There are reasons not to be overly optimistic in either scenario, thanks. But forced to pick an outcome would be relatively better for risk assets. It's useful to consider vol environments in both scenarios. So what they're doing, and everybody tends to do this at these banks, is say, hey, what if? And then what if? I've done this. I've broken it down into 3 categories. And if you're in the community, you know this. But what I did was I'll break this down and say, okay, number 1, 25 or 50. Number 2, the dot plot. Number 3, the speech. And then what you do is you add weightings to those, and then you look at the scenarios and what you think is going to happen. Then you assign a percentage to those. That way, when it happens, you have all your scenarios lined up, and then you're not surprised. You might be surprised, but at least you expect a certain reaction. Therefore, you're being proactive versus reactive. That you might want to watch that again. That's extremely helpful to lay out a scenario system like that, especially going into a key event. If the Fed cuts just 25, would not be unwind the September expectation. Yeah. If you only cut 25, all those rate cuts that are built into the bond market, built into XLU, XLRE, yeah, they're going to unwind. They're going to wind up coming in. I do agree with that. The aggressive easing into the end of the year, 120 to 100 to 75, sharp bear flattener front-end yields have decided the lowest levels in 2 years. The move could also imply a broader tightening of financial conditions in the coming months. Meaning, if it's only 25, it might get harder on financial conditions. On top of the immediate adjustments, the market would also have to account for an uptick in the probability of a policy error. Agreed. Maybe they should have done more because we already think they should have done something in July. So now we're in the camp again of saying what? These people have no idea what they're doing. No matter what happens tomorrow, we're still going to feel that. In addition to that, potential for a scenario in which the Fed is forced into an aggressive policy action, thick in a tight presidential race, correct. It's hard to imagine any of this alleviates the already heightened vol floor. Essentially, that's the VIX, only positive outcome for the markets, 25 basis points would be a string of stronger than expected labor market. So if they cut 25 bips and then they're like, well, we don't have to worry because the labor market's going to get better. Now, this is where it gets interesting. Note the terms that we're looking at. We're not talking about CPI anymore, are we? All of a sudden, everyone keeps talking about the labor market. You're going to hear that more as we go through this. Even this event, this information that the market would today, tomorrow, and next week. See, this is why I think they're actually setting us up for 50, because even her language is, oh no, 50's better. I have trust issues. It's larger to cut that gives the Fed more optionality and breathing room going forward, and perhaps will imply less market volatility. If the economy data does come firmer over the next weeks and the Fed maintains optionality to slow the easing, skip a meeting, or step down in cut size, why cut 50 if the market is in a dire situation? We'll draw Furley's wording, that's someone that works at JP Morgan. We think the basic principle suggests the Fed funds rate should be in the vicinity of neutral to be better positioned to respond whenever risk is realized. Do you think that they get wording from the Fed before they put this into their research? So when they're saying neutral, we'll walk through that later. But what you're getting at here is you're 150 basis points lower than the current policy setting. So a rate cut tempo, 25, takes almost a year to get policy back where it's supposed to be. We think this motivates front-loading easing at the start of the cycle, particularly since with hindsight, it may have been appropriate to cut in July. They should have cut in July. Then they would have done 25, then 25 again, and we would have been easing into this. But instead, what are we getting? More of JP. 50 would be more of a clearing event, and the markets will move forward assessing other potential market moving factors like earnings in the election. Agreed. Rip the Band-Aid off. Whereas 25 would add market uncertainty. So in a relative sense, this is why 50 is better than 25. So in other words, what I think they're doing here, JP Morgan is doing, is two things. One, they're leading their institutional clientele to say, hey, 50 is probably what they're going to do. Two, it's not that bad because it gives them more optionality. I'd like to hear your comments on this. I usually don't spend this much time doing this level of research. I save it for Saturdays. But as this started coming out between today and yesterday, it seemed more important for us to hammer this out so that we're prepared for tomorrow. But I do appreciate your comments. Now, yesterday I showed this graph, and the purpose of showing it was you're going into a cycle where when they start cutting rates, you hit a zero line. That zero line tells you what's going to happen. So in this cycle right here where they're going to start cutting, you're either going to get a recession or you're going to get increased productivity with rate cuts, okay? Avoid recession, which leads to increased productivity, okay? One makes the market go up, the other makes the market go down. Source is Goldman. Now, what's interesting about this is you usually know within 2 to 3 months which one of these you're going to have. That's pretty standard. That takes you right into November, December, right into the election. So let's just say it takes us into November 7th. It actually is going to take you more into mid-November, December, right? That means all the economic data that's going to come out becomes more important. And what we have to do is understand which of that data we really should be looking at. So if we start right here, what they're looking at right here from the labor market, and this is one of the investment banks, this is something that they said start focusing on this. What they're doing is saying, okay, start looking at payroll. Start looking at 3 months of payroll. This is the first rate cut. This is what happened in 2007. This is what happened in 2001. Okay, payroll, all of a sudden, the growth of payroll fell off a cliff. And then this is what happened in 19 and 95. Payroll was flat and stayed flat from that cut. So going forward, what you want to do is look at payroll and the growth of payroll. So what would we look at? Things like non-farm payroll, the unemployment rate. Right now, if we look at our trajectory and how we're dropping, we're dropping just like 95. And I've been saying that this reminds me a lot of 95. But candidly, I have no idea what's going to happen. This could just be mimicking 95 because it is for now. And it could absolutely get worse. But what we would look for is how bad that's going to get, where the zero line is, and where these drops would be. But for right now, you're tracking with 95, and I think that's important. I do want to point this out because it's not all roses, obviously, and we all know that. But this is delinquency rate on credit cards across all commercial banks. And you are spiking. Now, the reason that I'm showing this is because if we are to look at this and we see these spikes, well, that's 95 as well, where we spiked and we had a higher percentage rate. People are like, oh, well, this is really bad. It's nothing like 95, 96, 97, not even close. This is half of what that was. So as we're sitting here and saying how bad it is, it's really not that bad. It's nowhere near where you were in 2007, which was very close to that other graph. If you go back to this graph and you match it with payrolls, which is what you should be doing, and you go 19, and then you would go to 95, and then you go to 07, and then you're going to here to 01, and you come over to it again, and just look at 07 and 01. Well, 07 was substantially higher than anything on the chart, and 01, if we really look at it, hardly dropped during that period of time, right? But look at 95, and look at what's happening here. Okay, I think this is really important to note. And this is another note from another investment bank. And I'm just showing again, when we start to really look at this, just how crazy this is. Good reasons not to cut. And I believe this is Robo Bank. And they're saying that you should definitely not do it. Being wrong and cutting 25 is worse than being wrong and cutting 50. So they're taking the other side of JP Morgan. And what they're saying is we disagree the market's risk on for the FOMC to question whether it's a bigger mistake to cut 50 versus 25. 25 can be accompanied by a clear signal to justify 50. So if September, look at what they're looking at. Unemployment rate goes to 4.5. So now you know what you need to look at. Then we could do 50. And then we could do it again, 50, 50, right? Okay. See the difference in the way that these people are looking at this? Starting the cutting cycle with 50 basis points probably adds market pricing that's already aggressive on the easing. There will be more subsequent confusion and market disruption. In doing this for 25 years, I've never seen this much confusion and this much disparity between investment banks on whether or not they're going to cut 25 and 50. And I certainly have never seen this many cuts being priced in before. I think this is really important to get. I would appreciate your comments below. Now, usually I save stuff like that for a Saturday. Tomorrow is way too important. The level of volatility, in my opinion, tomorrow is being grossly underestimated. It just is. I'm just going to tell you that right now. We've never had an event like this in a long period of time where so much hinges on it. I want to start with the semiconductor. And what I'm going to do is I'm just going to leave the Ichimoku cloud in here. And if you were to look at that cloud, which way would you think that cloud is going? Would you think that cloud is going up or down, right? It's pretty obvious that you have an H here, right? I mean, just if we took off this for a second and we just looked at the cloud, you would say that you have an H, and did we break below that H or above that H? And you would say, we don't know what we're going to do, but we've hit here 3 times. So maybe there's a bottom here. Maybe. Would have been better if we undercut it and then rallied. And this is showing some signs that we are okay, but then we're going to take a look at a 4-hour and we're going to see something. And we're going to see that has broken. So from that December on, from November up, we have broken that trend line. It is very clear that we've broken the upward trend line here of the semiconductors, tried to rally back up, complete Matumboed, and it's very clear on the 4-hour that what? Every time we get in the cloud, they pull us back down. So that's telling us, think about this as weights on your back as you're trying to float in the water. I don't know. That's what I come up with. And that's the way that it feels to me, where this would be like if you're underwater and all of a sudden you have a ball and the ball's lifting you up. So that's my analogy. If you have a better one, comment below. But until then, that's what you're getting. So if we just focus on the stocks for a minute and then focus on finance, because they're the 2 main sectors of the market, period. So we want to even take a look at the RSI. We could see on the 4-hour RSI that we were oversold and we bounced back to neutral. So is that very simply just an oversold bounce? I don't have an answer to that yet. It might have been. So we're going to see that. Now, if you drop this again to an hourly, you can see we were overbought and then we formed this double top right here today, which you couldn't get above, right? And that just kind of coincides perfectly with this level that you guys can all see from there, that 233.55, and we can't get above it, and now we're rolling again. Okay, so that's what's going on with the stocks. Take a look at this on a 4-hour once again and realize that all you did was what? Work off the oversold and bounce back to neutral. That's all we've done, okay? You could actually make another argument here of left shoulder, head, right shoulder, neckline. My belief of everything, if I could tell you one thing to take away from this, and why I'm so focused on it, is that people are grossly underestimating the magnitude of tomorrow's move. And I think you should be able to see that. Picture all that research that I went over with you, that we just did, and picture investment banks making bets. Left shoulder, head, right shoulder, neckline. Not saying it's there, but it's there. Does it break? I don't know, but it's there. Take a look at XLF today. Now, this actually gave me hope, okay? But you have to look at a couple things. We're overbought again on XLF. So we're going into tomorrow, into the financials, overbought. All right, go take a look at on a 4-hour. Okay, well, we're above, we didn't go below, and we're okay. Do I have anything here that resembles what semis look like? No. So we could see rotation into the S&P, and we could see the S&P do what it's going to do, and we just might lose the NASDAQ for a period of time. And that's okay. Then we can just find the next sectors. Sectors that we've been in are like XLRE, and we're killing it. I mean, these things they're working out really well, but they're overbought. So what happens if we get to a point tomorrow? Take a look at this on the hourly. What happens tomorrow if we get to a point? You can see this very clearly, that negative divergence, and they come out with 25 and they don't like this. How ugly does this get, right? How much of this is baked in? I don't think a lot of this is baked in. I truly don't. I think that we have a lot baked in to interest rates in these interest rate trades. And I'm not so sure that the market's going to be able to respond to 3 critical things. You have the dot plot, you have Fed speak, when Powell speaks, and then on top of that, if we only do 25, I do think some of these interest rate names are going to sell off. And I'm not really sure where the flight to safety would be. So from my perspective, I think the best course of action is to see what happens and then react to it. That's it.